Institutional capital is paralyzed. Trillions of dollars are caught between two opposing macroeconomic forces, applying immense pressure but yielding zero forward direction. We can see this paralysis perfectly in gold, or XAUUSD. Look at the recent price action. It is trapped in a series of violent, unresolved whipsaws directly between the $4,400 and $4,600 levels. The first force pushing price upward is a classic safe haven bid. The ongoing geopolitical crisis and the closure of the Strait of Hormuz are driving capital heavily into hard assets. Restricting a major maritime trade route severely throttles global supply lines, which inevitably forces a sharp surge in crude oil prices. That surge translates directly into a global energy-driven inflation shock, and that sticky inflation triggers the opposing force. To keep prices under control, the United States Federal Reserve is forced to hold interest rates high, pricing out expected rate cuts. When the Fed commits to a higher-for-longer rate policy, the U.S. dollar strengthens. Since gold is priced in dollars, a strong dollar and high Treasury yields act as a massive headwind, capping any upward momentum. Fear-driven buying at the bottom is perfectly neutralized by yield-driven selling at the top. If you rely solely on standard fundamental analysis right now, your pricing model is incomplete. Institutional capital is actively rewiring its pricing models to account for a prolonged Middle East conflict. Phase 1, the inflation shock. Surging energy boosted the dollar as capital fled bonds and gold for cash yields. But as high rates persist, we enter a growth shock. Flows reverse, leaving equities for the safety of bonds and gold. When growth stalls while inflation remains high, the traditional correlation matrix between equities, bonds, and hard assets completely breaks down. Equities face intense selling pressure because corporate earnings shrink in a high-cost environment. Meanwhile, bonds and gold, which were previously sold off, suddenly find heavy underlying support as ultimate defensive plays. This transition from inflation fear to growth fear is messy. Algorithms are rapidly repricing risk, causing extreme structural volatility across the board. To accurately model gold's next directional expansion, traders have to take this high-level macro transition and map it directly onto lower timeframe liquidity pools. This is the daily chart for XAUUSD. We are moving from macroeconomic theory to technical reality to establish our primary battlefield. Despite our recent recovery bounce off the $4,099 lows, the higher timeframe momentum remains mildly bearish. That bearish pressure is maintained by a rigid ceiling capping the price action, the 100-day simple moving average, currently sitting exactly at $4,637. We can confirm this downward pressure by looking at the bear cross that occurred on March 25th, where the shorter-term 21-day moving average crossed below the 50-day moving average. The asset is being defended by a structural floor. There is a heady demand zone at $4,400, sitting just above the rising 200-day simple moving average at $4,129. Looking at the daily relative strength index, a momentum oscillator, the current reading near 40.90 indicates that bearish momentum is persistent, but not yet exhausted. On the macro timeframe, gold is simply compressing between these long-term technical boundaries, biding its time until a definitive economic catalyst forces a breakout. This is the 15-minute chart for XAUUSD. By zooming in from the macro daily view down to the 4-hour and 15-minute charts, we can observe the specific algorithmic behavior driving the market. The current lower timeframe price action is merely a corrective bullish pullback, trapped inside the larger bearish repricing. A specific compression pattern is forming, an ascending channel where buyers rapidly lose momentum approaching the $4,570 supply zone. To understand this, we apply the smart money concepts of equal highs and equal lows. This slow upward grind is a deliberate algorithmic trap designed to entice early sellers and build buy-side liquidity, clustered stop-loss orders just above 4,580. Simultaneously, the market is building a matching pool of sell-side liquidity as early buyers place their stops below the $4,441 and $4,420 pivot points. Institutional algorithms use this as fuel. They plan to sweep these extremes, to execute massive institutional orders that would otherwise cause too much slippage in a thin market. Trading within this mid-range of $4,514 to $4,560 is highly dangerous. Retail traders operating inside this channel are effectively providing the exact liquidity that smart money intends to hunt. These algorithmic liquidity traps are highly sensitive, and they usually sit dormant until a geopolitical headline serves as the catalyst. For example, rumors of a potential U.S. de-escalation in Iran or sudden shifts in executive policy and tariff threats act as sudden, aggressive bearish catalysts. When that news breaks, a liquidity grab occurs. Algorithms instantly push the price past support to trigger those retail stop losses, and then immediately reverse the trend, leaving nothing behind but a long wick. But a fake-out sweep is different from true structural displacement. When real institutional momentum enters the market, it leaves behind a fair value gap, or FVG, a distinct pricing imbalance in the chart that proves the move is genuine. Differentiating between a brief, headline-driven liquidity sweep and a true structural break is the essential skill for surviving the current macroeconomic chop. This brings us to the 4-hour chart's decision tree. The first path is Scenario A, confirming a bullish expansion. The primary trigger here is price achieving a clean break and holding above the heavy $4,580 to $4,603 supply zone. Displacement is strictly required here. Slow, overlapping wicks indicate rejection, whereas large, imbalanced candles confirm the market has accepted pricing in this premium zone. If this structure holds, the immediate target is sweeping the $4,675 liquidity pool, paving the way to test that rigid 100-day simple moving average. For this bullish scenario to materialize, the growth shock narrative must take over, forcing safe haven demand to completely overpower the strength of the US dollar. Back on the 4-hour chart is our higher probability path, Scenario B, bearish continuation. The trigger is a sharp rejection from premium supply, breaking down through the rising trend line at 4,497. Order flow will then aggressively target sell-side liquidity resting at 4,441 and 4,420. If inflation remains sticky and Federal Reserve policy stays hawkish, the extended downside target for this drop is the major demand block sitting at 4,350. The market is caught transitioning between two distinct macro regimes. Trading in the middle of this range is a chaotic slaughterhouse for impatient capital. The ultimate edge here is discipline. Professional traders avoid the compression. They wait patiently to fade the inevitable liquidity sweeps at the absolute structural extremes.